What you want is a stable of good horses, a fast one, a rugged one for all seasons that pulls a plow, you know, all of them. Don't be foolish. And the anti-fiats are the category where you should be overweight, and the debt markets are the category you should be entirely underweighted to zero.
Real yields are seemingly back. The US dollar is struggling a little bit. Gold is hanging in there. And we're now looking at the fundamentals. I invited a technical trader, a renegade trader and technical analyst, actually, Francis Hunt, to the program. He is the market sniper, and he's joining us now from his office down in Panama. Francis, it's great to have you on the program. First time on Soar Financially. It's good to see you, and we just chatted for 20 minutes already before hitting record, so I'm tremendously excited about what we got in store here. Good to see you.
Delighted to be with you. Thanks for the invite, Kai.
Absolutely. Yeah, no, Francis, like we have to start with a very brief introduction of yourself because it's the first time on Soar Financially to kick things off. Why don't you quickly tell us who you are, who's the renegade trader and the market sniper?
100%. It comes down to a simple, really dominating theme. What is the truth of the matter? And it's very hard in deception times to actually get to the truth, which one of the reasons why I'm a macro technical analyst. I look at the actual movements of money as recorded by markets, where there are real weighty players in the market expressing views. That is the truth. Don't do what they say, do what they do is an axiom. And as a result, we've been able to call the collapse of the euro to the Swiss franc in 2009, well before any of the Greek crises happened. The peg failed again subsequently. We had 3 separate major trades on that one. We called the collapse of the oil price before the events of March 2020, well in advance. 2019, we were seeing their weakness. So that is what charting with real patterns and utilizing the HVF method. In other words, we've cut a niche out of technical analysis. Like many topics, dogma and academia sometimes get involved. We have no interest in lagging indicators such as moving averages and price mathematical based indicators. So we look for the leading indicators such as yield curve inversion in macroeconomics and such as patterns and volatility compression in price behavior. So that is our speciality.
Fantastic. No, appreciate that introduction there, Francis. We have a whole, what do you call it? Like a whole group, a flurry of topics prepared here. We're going to talk macro and then distill it down a bit to talk about commodities and the miners, because we discussed beforehand, like, why are they lagging? You know, where's the sentiment? What is the issue here? And you already hinted at some of your possible answer. We'll get to that later. We're going to discuss some stocks in particular. Kamiko comes to mind. I want to look at that one, but also maybe at the only miner in the S&P 500, Newmont. Just as an indicator, because out of 500 companies, they're currently ranked at 485th out of on the 12-month performance. So doesn't look too great for the miners, but I want to find out why. Let's start with some topical discussions right now, like some topical trends. You have some themes you're following right now, because we're going to break this into a 2-part conversation. Okay, we're going to talk about something that is happening right now. 2 topics that you brought up is Bitcoin is breaking out at over $28,000, which is, for me, personally, I'm not a Bitcoin expert, but I find it interesting and. I respect Bitcoin. I'm not a gold bull, gold bug, or anything. I'm not in either camp. I get it. It's 2023, and the Japanese yen, which brings us sort of back to the macro discussion as well on what is happening. But we're going to start with those 2 topics. Bitcoin broke out, so I'm asking you now, like, what is driving Bitcoin? Where's the renewed interest coming from? Because when it hit 16,000, everybody, especially the gold side, the gold bucks, were saying, "Well, it's done. Let's move on."
Yeah, it's a great question. So first of all, thank you for the invite. And the topical matters that are absolutely hot right now, as gold is gestating for a while, which we'll refer to later, right now is, in our opinion, the bottom call we've made at the 15.5 on crypto. So we are global macro. We look at everything. And that is leading with the big caps first. So the major liquidity is chasing up first, which tells me it's institutional money. It's not the retail guy with his favorite token that's number 33 on the market cap that has, a couple of a million, 50 million market cap. You're talking about the Bitcoin. Don't forget, it's still a 500 billion market cap. It's above that, in fact, and it's running quite a bit. So it's quite a significant, if you're thinking of it as a corporation, it's quite significant. That is definitely in a turn. We've called the Bitcoin dominance as a turn, and many people are falling asleep. And crypto right now, people don't want to hear about it. Starting the interview and even mentioning crypto, you could get a lot of people that get turned off. And I'm here to tell you, pay attention, because the entire relationship with NVIDIA and this whole H1 about the AI doesn't go on without crypto being re-engaged. And the other element about it is there's nothing but bad news flow that has come. So you've had a lengthy bear market that came out of a head and shoulders top quite some time ago, and it's been one of the longest bear markets, and it's bookended with an inverted head and shoulders. So we have this beautiful symmetry, and that is turned, and that has a 40,000 plus before it even has a rest. That's not a top call. That's just the first leg up before it goes further. And this is moving, and it's a higher beta. So for those, many people want a bit of excitement. They're battling with the gold, and I'm a gold bull, by the way. I'm a sound money advocate at the macro and fundamental level, but this is where your action is right now, if you're wanting action. So crypto and Ethereum is second in market cap, major turn, inverted head and shoulder. We can maybe pop over and show you a few charts, but I just thought I'd give a opening preliminary statement to that. This is a bull market that you're currently not participating in, and you'll end up FOMOing in 6 months later, 2.5 times higher, saying, damn, it's become cool again, and it's sounding uncool now. Then there's the macro trade. So we are global macro. The short answer on the Nikkei long as a European, and Japan is a funny old place. It's also outside of the cool space for us now, because we're pan-European, we're Western, we're American. We don't actually spend a lot of time thinking about Japan. But in a global macro sense, we have had interest rate rises across the board, including the ECB, including the Fed, and the one particular central bank. And don't forget, this is a massive economy with very high number of great quality companies that has not moved the needle on interest rates and is actively doing something called yield curve control. That means they are artificially supporting a chronically over-indebted market, 300% to GDP, somewhere between 280 and 300%. So this is your broad stroke number. Don't quote me exactly. So it's chronically over-indebted, an inverted pyramid of demographics, as I like to say, more men, grown adults wearing nappies than children. That's a very bad demographic. Lots of investment of citizenry and pensions all in that bond market, and that's why they're sustaining it. So what happens if you don't up interest rates, but you've got inflation? Japan's also had inflation. It's a massive importer of commodities. So the theme is that currency takes the hit. So we're seeing chronic yen devaluation. This is a major currency. We're not talking about the Turkish lira here. We're not talking about the South African rand. This is a first world major currency that and we have for our Europeans, I know you're in Germany, you've even got very bullish setups for the euro, which is a fatally flawed currency against the yen, just to highlight how devastated the yen is going to be. And we have a target of 233 on the euro yen. Of course, I prefer to trade that with the Swiss franc and others, or gold, which we'll also be coming to, but there's a chronic devaluation in the yen. What that means is, to finish the statement on the yen promptly, is that you have high quality export orientated major international Japanese companies that actually have a yen hedge. In other words, they don't rely a lot on domestic market. They may sell 10 or 15% of their product there, and they sell in dollars, euros, Swiss franc, and everything else, and even Mexican pesos, which have been very strong, Brazilian reals that have been strong recently as agriculture has come up. So they have a yen hedge. So we're going to see Nikkei not only take out the high that it seemed never to take out of its debt boom in the 80s, but going well past to 57,000 and beyond. So that's a huge macro trade. Nobody is talking about it. I'm watching Druckenmiller. I'm watching everybody. Nobody seems to be seeing that. I'm either deluded or there's something going on there. So that's the opening statement for those two categories of current real interest. And it's happening right now on a chronic level.
Those are some really interesting ideas, because we've seen a bit of yield curve control in the US as well. And we'll talk about that, because Japan, I've been asking that in other conversations before as well. Is Japan a blueprint for the US? Because like how high can you raise the debt ceiling before either the politicians go go berserk, meaning, okay, our interest payments are way too high. We can't afford this anymore. We got to pull the plug. Or do we go to 200-300% of debt to GDP ratio at this point, right?
Well, in fact, there's a couple of points to come in on the differences between the two. In fact, if you actually added in the unaccounted for obligations of the US government, America has probably surpassed Japan and are closer to 600+%, because welfare, Medicaid, and all of those are off balance sheet items, which is basically an accounting anomaly. But take that out, America has the exorbitant privilege of being able to generate dollars. And Triffin's dilemma is essentially you export your currency and you are a net consumer of everybody else's goods. So long as you are, which, as we all know, is now coming under threat since the Bidenomics of the disorderly pullout of Afghanistan, which undermined the military aspect, and the stealing on the rails of the payment rails of Russia's money, two fatal errors, in my opinion, starts a de-dollarization process. What you're actually seeing is you're not pricing in the fact that that privilege is being eroded away, and they're being priced at old America rule of law values, where in fact that rule of law is now being politicized. So yes, there's that, but the comparables with Japan invested domestically in their own debt. America has relied on the international market extensively to purchase and support their debt. So there's one difference there. And then there's the demographics that is far worse. You have the pensioners now in Japan and a very inverted, as I mentioned, very low children. Only South Korea has less, at 0.88 kids per couple. You're on 0.91 in Japan. So Japan is the accelerated first of the major dominoes to fall. Essentially, reset is trading the falling dominoes in the order that they are due to fall and taking the profits from each and moving on to the next one, because you're not going to have one nuclear holocaust where everything goes up exactly on the split second. You're going to see contagion. You're going to have dominoes falling. The largest of the majors, and the currency is going to be the key thing, and that's going to really boost the quality majors. So a Nikkei 25 long without the yen exposure for offshore people is going to be potentially very, very profitable.
Interesting, really interesting commentary, because you're the first one to bring up Japan. I've heard Brazil come up due to the commodity pair trades that are coming out of Brazil, but not really Japan. So I find that interesting because I've asked about it before and nobody really had an opinion. And you brought up sovereign versus internal debt, which is interesting because that brings me again to the gold price. Why the gold price is higher or still elevated or at a higher level is because of sovereign credit risk default. Or default risk. Southern credit default risk is one of the terms, and I'm not an economist by any means here, but that's one of the reasons why gold is still being used or as a safe haven investment, right? There's still a bit of a risk that the US might default, right?
Oh, indeed. And we just because it's currently not shining, we broke a number of technical levels and we pulled back. It may, maybe we'll turn to the charts. I thought maybe I could just show you very promptly the Bitcoin and the movement.
Yeah, let's get to gold later. Let's in the later conversation. I just wanted to bring that up because we'll get back to that. I think that makes sense. But Bitcoin, I'm curious about, because I'm not a Bitcoin bro, right? And quite curious to learn more about what is happening there, because I find the connection with AI, and I'm guessing it's computing power on the graphics cards as well that are being that's the connection there. So let's bring you up on here. There we go.
Indeed. In fact, before we jump in, seeing as this chart is up, you did we were talking about leading indicators a lot, and I have a great focus on things that lead. You need to be early. You don't get to be first, but you need to be early. On the US side, and I'll just give you a better screen view here. This is the long-term history on yield inversion before I run into the cryptos. And I did this chart and I prepared it, so it would be great to maybe share it while it's up. This is the 10-year minus the 2-year. Now, the key thing is, it's a funny how all the unpopular markets that you're not taught to think about too much. Everybody understands stocks. Everybody understands an index. Everybody understands gold to a degree, but people aren't talking about debt markets. That if you haven't visited Japan, people don't tend to think of it, even though it's a massive hub. And of course, if you've been in crypto and burnt before, the last thing you want to hear is, oh, that thing's starting again. It feels like a girlfriend that's cheated on you before. Most people got damaged by it because they're chasing late. I'm talking about a lot of things that are often quite unpopular. And yield curve inversion washes over people because it's about debt markets, which people don't truly understand. And then it's one debt market minus another. That's already a step too far. And it's actually a brilliant fundamental lead indicator. It literally has a 100% record. And if we're taking the 2-year of the US yield from the 10-year yield, you will see the early 90s slump is in this orange box was captured. So I'll just grab and highlight nicely so that everyone can see where I'm pointing. Early 90s slump. The big crash that came with the 91, 92 actually follows the yield curve returning back up. So the inversion is the precursor. Then comes your slump. We inverted very slightly in 98. Then we had the whole Asian crisis currency. We inverted in 99. And then we had the dot-com crisis. We inverted as early as 05 and 06. And then we had the 08, 09 crises. So you see, it's a leading indicator. And I'm here to tell you that we inverted in September 2000 and October of 19. And most people don't realize that. That is pre the events of March 2020 and the lockdowns and all the associated, I won't say the phrase. And then you went into that particular event. And take of it whatever you will in terms of how that came. I'm here to highlight to you that you are currently in the most extreme inversion of the modern era. So we take the 80s, you have to go back, 50s, 60s, 30s to find a yield curve inversion that has gone further lower. This current inversion level, which is the difference between what is being yielded on the 10-year and the 2-year, is so high that it's surpassed the events of CV19, subprime, dot-com crash, and the Asian crisis and the early 90s recession that was George Bush #1, pre-Clinton taking over of him, where they had the recession. This is surpassed substantially, and we only start to have the great, and geometrically, the larger the dip, the bigger the pain, I'm afraid to say. These things don't get bigger and turn out damn squids, unfortunately. So it's not always perfectly proportional, but it typically is. So we are waiting the reversal back up on yields to get the date when we go into complete meltdown. So this is a bit of a black pill that I'm feeding you at the moment, and yield curve inversion is part of that. So there is something really big, and I think we see a whole new financial system coming out of that.
Yeah, I got to jump in because just for my clarity as well, maybe for our audience, because there's a massive T-bill issuance coming in the next few weeks here. The U.S. has to raise $500 billion in the short term, $1.3 billion till the end of $1.3 trillion till the end of the year. So I'm just trying to understand, because the 2-year is at 4.73%, the 10 years at 3.73 right now. It's pretty much exactly 1% gap here, or inversion as you call it. Where does that come from? I'm trying to understand that, because the 4-week, the 8-week, the 3 months, and the 6 month are over 5% right now. They're 5.1 and higher, right? Is that are investors really that scared that the U.S. is going to default on the next issuance?
So in our overall view, the events of March 2020 was the end of a 40-year bull market. We were the first and the loudest, but it didn't get much attention because everybody expected the bond markets to remain strong in August of 2020 to say, that's it. You're only ever going to have higher highs on rates and higher lows. You're going to have an interest rate environment that is going to remain stubbornly high. And we've coined the term hyper stagflation. You have never experienced anything like that. People have associative thinking. They say, oh, you mean like the 70s? It's far worse, far larger than the 70s, although there is some essence of a similar aroma if you have to do some level of associative thinking. That means you're going to have stubbornly high inflation, stubbornly high input costs on bread, food, and everything else of that kind of nature in an environment where there is actually an immense amount of demand destruction and the retail average consumer is getting crushed. This is an impoverishment. We talk about the Goldilocks years of Greenspan, where he continued to keep very low rates and allow assets inflation, which was supervaluation of stocks, supervaluation of bonds. Every dip on the stocks was to be bought, every dip on the bonds were to be bought. The 60-40 portfolio was, you know, the genius moment. It became a meme, and everybody, when the stocks went down, you got it on the bonds. People ran into bonds. It was a simple old play. Both reached a point where they are so hyper valued. And this was the era of searching for yield. And our opinion, and this will dovetail a little bit and bring us into gold and its role, and also some degree Bitcoin, which we're still to show you the chart on. But our opinion is that you've gone from a search for yield era into a preservation of capital era. So much, the fact that something yields doesn't make it worthwhile if it's going to get a 40, 50, 60, 70, and even 95% capital decimation. So having something that is still there and won't go away and still retains all the same properties, such as gold, which is the reason why gold has been such a stalwart for so many reasons, is that it is never going to change. Your bond will lose an incredible amount of value. So I'll just also revert back to share screen. I'm just going to show you this turning technically, and come in if you choose. Technically, we've had a major change of cycle in debt markets, and it's now a capital preservation theme. What do you think on that?
I find it interesting because personally, I'm quite interested in a 5.4% yield on a bond, because on the inflation side, it seems to be coming down. I just bought a pound of butter for €1.25, which was €2 not too long ago, right? So I feel like I've got some purchasing power back here. So
you will have plenty of temporary phenomena like that, I imagine. And I think you should. The problem with people is they get excited when there's a bull market in something. They get excited by the pullbacks, and when there's a bear market, they all want to buy the bottoms and get excited by minor rallies. This is a trend-changing event, in our opinion. This is your yields of bonds. And I've gone back, I'll have to check, I think we're back to the 80s, 1988. I'm starting here. It goes right back to 81 when Volcker had peak bonds. But as you can see, the yields have continued down, down, down. Now, if I log scale this, because log scale is better when you're looking at long term, this event of March 2020 was a final capitulation. And technical analysts will tell you, and I am a macro technical analyst, that for a trend to die, it dies on a final blow-off of strength. That was strength in bonds, collapse in yields. It was a blow-off in strength. And as a result, you get that rally, and you're now taking out previous highs, and you're making higher lows. So in our overall opinion, while you might get a slight release in interest rates because they put up rates very fast, you're going to get a release. Major moves are more likely to be upside ones, even though you might get 2 cuts of 0.25 maybe, or a flat or a pause period for a sustained period. Our prediction is major moves to the upside. Don't forget, you have got the ESG, which is, we call it the watermelon communism, coming away. You have the downsizing of farming and agri capability in Europe and America, where very peculiar activities. You have the bifurcation of the supply chains with what's gone on with Russia. And even if there is leakages there, and that pushes prices up, you have intermediaries smuggling, breaking rules, whatever the case may be. This all adds to the cost of something. As a South African who lived through the apartheid era, we still got things, but they just cost a lot more. There were people bringing things in via things. So we understand that principle. None of that is seeing core price inflation long-term go down. And in fact, agriculture became such a bad business. The farmers got crushed in the States. If you weren't 40,000 hectares big, and you had to run at that level of land, plus, going to 100,000 for certain commodities to even make money. And this was with incredibly expensive equipment that required financing, etc., like combine harvesters, and you had to run that farm on about 4 or 5 people. So you have reached all your economies, your efficiencies that you can, and it's a marginal business. So what we truly need is sustained price increases. And if I were to show you the agri sector, as we're discussing this, you've had sugar go on a major run. You've had Robusta coffee bean, which is the cheaper bean, which is also run more so than the Arabica. So I'll show you a couple of these elements, which just ties into the agri. Don't forget, you're seeing the Brazilian real climb as an agricultural agricultural exporter on the back of this. You're seeing the Mexican peso climb, agri and also mining, and also friendshoring as it's benefiting of the bifurcation. So let's just show you that Robusta coffee chart. This is a major bust out. If I go to the weekly and just focus on the recent moves, this is a substantial move on the cheaper bean. We were looking in at this a long time ago in the early parts of 2021. You had a reasonable pullback, and that's when everyone will say inflation's over, and then bang, you go again. This is Robusta, and this is well behind.
Can you compare that to Arabica? Because I'm more of an Arabica drinker. I don't drink Robusta.
Most people do, but when the cost goes up, the cheaper one is running first because it's a cost. They obviously use it in blends. So if you go to the Kansas, that's still Robusta. I need to go Arabica bean, bring it up for you.
Just curious. I was just in Ecuador and in Colombia as well, so that's why it's top of mind.
Oh, absolutely. And but people have to remember this particular bean grows. It's currently selling off, but it's come a long way since the 2021. So you've gone from 100s down here, and you're in and around the 206s. Now it is the more expensive bean, so I would argue you get more substitution now to keep the price of coffee down. So the cheaper bean is running blends, often incorporated. So the Robusta bean has a stronger caffeine content, so it gives a bigger hit. It's more bitter, but the tree grows much higher and lower than the Arabica. The Arabica needs a very finite altitude. I think it's around 250 feet above sea level to about 300, 400, and much more than that, they don't do well with any form of frost. It's Robusta because it's a more robust tree. So I think you're seeing substitution, but you're still seeing a double from the lows of 2021 here down at 100, in spite of it looking a bit soft. You compare that with sugar, for example. So we're talking about agris. We are seeing a whole swathe need for bigger prices, higher prices for simple everyday commodities. If I go to the number 11 contract on sugar and just show you, this is another runaway market. You are at the lows. Admittedly, it was stop the planet lows, 9, and you're at 25 here. This is exceedingly high. Even if I go up on a monthly, you can see that this is a chart that is building to the upside. It's not one I would be shorting. So we had the chronic sell-off that went with the March 2020 events and a bit of the precursor on the problems the year before. But you're at 450, and today you're at 25. That is an item. And let's just be clear, all the dietitians and everybody are telling us all the great evils of sugar. So, you know, there's probably a Western reduction in usage of typical cane-grown sugar, yet you are from 2002, 2003, you're 6 times more expensive. And that, don't forget all the margin that gets added on that along the way. At just a producer level, your supermarket chains and their profitability is getting added in a percentage level on all of that. So agris are moving. Farmland has gone up as an example in case. So the concept I'm making is a hyper-stagflationary one. The reason we're looking at the agri charts. And I just wanted to say that doesn't see you go back to normal. This started with the debt markets. You don't get to go back to 0.2 interest rates on bonds and sub 1%. It's just not happening. The cat is out the bag now. People have lost faith in debt. And we've got central bankers buying gold and actually dumping US treasuries, particularly the BRICS nations.
Seems like we're building up a lot of excitement about the gold price and the gold price discussion here that we're going to save for a few more minutes, because I want to come back to Bitcoin. And I really enjoyed your points you made about sort of inflation and why we'll never get back to positive yields, really. Although it's like I'm looking at the shorter term bonds and the real, I'm struggling with the real yields versus, inflation right now, because CPI officially is 4%. I got to work with the official numbers, right? And I look at the short-term bonds, at least. It's like, why shouldn't I buy a 5.4% bond that's maturing in 6 months? Do I expect the US to go belly up here? I have a hard time.
I think you actually do have to resize the scope for that to happen far higher. So we took 40 years inflating this bubble. It doesn't have a slow unwind of 40 years where you can trade the rallies and grab a bit of yield. My personal opinion is you should have no debt at all in the debt markets of today, because the sudden change, the sudden violence that could befall you will take. In other words, don't collect. I'll give you a German example. You're in Germany. I'm not running onto the Autobahn fast lane to pick up 5-cent pieces, because I'm going to get smashed by someone in a Porsche Turbo doing 300 kilometers per hour. It's a bad risk-reward trade. You're collecting dimes, and the downside is huge. I turn into mashed potato, and that I don't want. So the whole game is go. There are other options. And the thing is, these rates are meant to tease you in to do the wrong thing. The retail assertion is always nearly wrong. I have to quote Mark Twain, when aligned with the 95%, stop and rethink again. The notion of going, oh, it's a good yield now. We've never had a yield so good. It's a good yield for a reason, because it's going to get better as a yield as its capital value keeps going down, as you have stubbornly high inflation. And in fact, holding gold is a capital preservation tool. Holding Bitcoin, and there's this popular antagonism between the two. It's come out of Peter Schiff, Michael Saylor, I think it is, and Silbert on the Bitcoin side, that you have to be either one or the other. And it's, if I'm Liverpool, you Manchester United, or Bayern Munich, you have to be
Borussia Dortmund.
Borussia Dortmund, exactly. So we have to get out of this. What you want, and there's this notion of, I have the fastest horse. What you want is a stable of good horses, a fast one, a rugged one for all seasons that pulls a plow, all of them. Don't be foolish. And the anti-fiats are the category where you should be overweight, and the debt markets are the category you should be entirely underweighted to zero in my overall portfolio allocation. You should not be chasing yield in the end of the search for yield era. We are in the capital preservation era, and that's what will build you relative alpha. This was our call on Bitcoin. So we've done a couple of calls. People that are following our YouTube channel will know that's the Market Sniper, and the Crypto Sniper is a specific crypto channel, because we have to deal to the fact that everybody's divided about this. But in actual fact, you had a inverted head and shoulders here on this draw. I'm going to show it to you. I'd have to go up to a 3-day just to get it into view. But Bitcoin is a runner, and we see the 40K. So if you want to make money, forget about emotions and stigmatizations and everything. This is an on-ramp for CBDCs. I have no notion of freedom from government. They are never going to let you have your own money. I repeat that 3 times normally. Out of respect to your audience, I won't do it on this time, but I need people to understand. You're not suddenly going to get away with having your own money in this realm and world.
Francis, I got to jump in real quick, because just for my understanding, to frame the conversation, like, how much are you removing your technical analysis from what is happening on the news side? Because now there are bigger banks coming into the Bitcoin space. ETFs seem to be are getting approved. So there's excitement building, right? So sentiment is changing again on the crypto side. Like, how does that factor in? I think that is, something we need to address as well.
100%. Well, first of all, charts. So you either are a fundamentalist or you're a technical. The chart shows you something earlier. When the big money starts moving, you get to be in the first 5 to 10%. Fundamentals, by the time you're reading the news, it's already either begun to be baked into the charts, or it's already is baked into the charts entirely, and you're about to buy the top and get a fashionable pullback put on you. You're going to be a bag holder. So the news actually in crypto has been dire. The news in crypto has been absolutely poor. In other words, there's been the SEC's action. Let me just, sorry. The SEC's action has been chronic. I'm trying to get my drawing tool back up. The SEC's action has been chronic and aggressive. It has stigmatized most cryptos as securities, maybe rightly or wrongly. I don't have a view on that. It's not my place to have a view. But the point is, it's been terrible news. You had the events of FTX. You had hedge funds going down before that. We warned people. We are not perma bulls. There's a lot of moon channels, as I call them, on crypto, which are childish, younger generation. Everything is up. Tell me what I want to hear. We warned people about this rising wedge. We said there's more downside to come. That's the FTX events effect on Bitcoin. And then we hit a lot of targets. This purple line was a target to the downside from Head and Shoulders. People that understand a little bit about technical analysis, that's a right shoulder. This here was a left shoulder. And this is a big head. So that is typically how trends end. You have a break, you then rally right up to a similar point, which is the 25K key number or key round number of significance, and then you wait for the break of that round number. And we suggested the 20K would be run on the downside of this right shoulder. We got people in just sub 20K on the right shoulder because we saw this head and shoulder coming and this bottoming. And that was a great move because they had a fabulous move up to 31. And then actually during all of this period, this is quite a busy chart. There's a lot of draws, so it's multiple time frames. I'll just take the eye off for a while. During this period, you've had the sustained SEC action, which has been bearish, and it's come down very gradually. This is technically very bullish. And it's called a revisit to the key level of 25K. We gave a second bull call at 24,800 and said, you're technically going to just run the 25K and you need to be in. This is the response to that bull call. You're straight away, you've knocked back on the door of 30K. So these are really bullish fundamentals. Just hold your nose if you hate crypto. The fact of the matter is this is playing a role. BlackRock is the super whale of everything. And I don't like them. I don't like what they stand for, our freedom. But the fact is, there's a difference between making money and expressing an emotional. This is not Celebrity Big Brother, where you vote for the person you like most or hate least. This is the cold pragmatist, the rational. Rationality must dominate. Is it going to serve you? Will it go up if you're going to be a buyer? And the answer is yes. We are long both this and Ethereum, and have had amazing technical setups that have worked for us. How far does it go is the next question. Many of your
I was going to ask you that next, actually. Like, what's your prediction? Because that is a straight up candle right there.
Absolutely.
It's a big green candle as well. So do you see a gap fill back down to, what is that, 28.47?
When you're answering that question, there is a complexity to this. There is investment and there is trading. Trading, I utilize leverage, which means I have a carry cost. I need to be more accurate with timing. I use it very lightly and judiciously. And then there's investment. I am investment long for us, the entire bull market, a number of tokens, one of which is XRP, a status token that I think is going to be unveiled as being central to all the CBDCs. That's the fundamental narrative, but in fact, it's technically very interesting. And we think it's going to go up 33 times. Yes, you heard me right. Bitcoin is the first to move because it represents the liquidity. So I am using my XRP collateral and another token that for now we're keeping under wraps, but we're very bullish on, that will do 60 times in our opinion. And we are utilizing that, and I've got a leverage long on Bitcoin and Ethereum. So to answer the targets question, I will close leverage at least 50% of my current sizing at the 40,640. So we have a flag here. This is a flag. You can do the small flag draw, the conservative flag draw. Let me just take straight lines. It looks less messy. You have a flag in there. You actually have the macro move, which is also part of a flag. So we have two projections in all of that. And you also have the inverted head and shoulders with that blue line that we gave you. The inverted head and shoulders is a very reliable target. It's at 40,649. Just before that, as you approach 40, you'll get the first of the flags targets. So my suspicion is as you run through the 40s, the low 40s, you're going to pull back and churn a fair amount. And that is going to be, there'll be a reason for that. You'll be at previous levels that were very significant on the way down. So what was once significant on the way up becomes significant on the way down. This was a bear flag. And we were bearish, as I assess. and continue to reassert, we are not perma bulls. We want to be in something when it's going up, and we don't want to be engaged when it's going down. This was a prominent flag. In fact, let me just reframe so that you can get the top of that market move in there. This was a prominent flag on the way up. It's likely that it will pause and churn sometime here. Similarly, from the 69K to the downside. So that was generating a target. By the way, that gave us a beautiful target. This was the head and shoulders. You can see the target exits here and here for the end of the bear market. So we stopped being trading short there. So we weren't perma in love. We are absolutely dispassionate. And this is the hardest thing to get new traders to truly appreciate. They like things that have given them previous money, and they dislike other ideas for various reasons, because it's government, because it's this, or because it's that. You've got to recognize that which you control, and you've got to build your wealth through rationality of what's likely to go up. And as a result of this, this is likely to go up. I expect it to pause in and around these areas and pull back. I would close leverages, and I think opportunity on a pullback to get back in again, but then eventually new highs. So it will be a localized high and a pullback period where it will churn. And that's going to be very bullish. And I will also just
I want to jump in real quick. It's like, or if you want to put a bow around it, but I want to get to something that you mentioned before we hit record, is that Bitcoin and the cryptos are being revived as part of the sort of AI boom that we're seeing in the main markets right now as well, that they're benefiting from it. So I'm trying to make that connection as the last point before we wrap up here with our part one of the conversation.
100%. I don't think you have an AI world without a cryptocurrency attached to it. The AI realm, just generally, is it's going to be huge. I think the chip, I would not be a buyer of NVIDIA at 35 times revenue. I remember Scott McNeely of Java saying, how could we only ever go down on our equity in the dot-com boom when our company was valued at 10 times revenues? That's even if he paid no salaries, had no expenses and no tax, it would take 10 years where 100% of the revenues were profit, which is obviously an idealistic oxymoron. You would take 10 years before you even got your money back. NVIDIA surpassed that to the 35 times. So people have already baked in an unbelievably large AI boom. So to go in long now is to say, no, it's not going to be unbelievably large. It's going to be infinitely unbelievably large. That's a dangerous game to play. But the cryptocurrencies, the metaverse, the gamification, the paying for a better gun to shoot villains, this whole theme is not going away, and those will come back into bearing, and they are hammered. They're the uranium of the energy market 3 years ago. They're the silver at $11 at the bottom of March 2020, or at $4 post the dot-com boom. They are hammered. And that's where the cryptos are right now. And you're getting the second biggest market cap, Ethereum. We called our whole community long on an inverted head and shoulders, left shoulder, big head, right shoulder, take the trade. And we're almost at that target where it will have a wee rest as well. And this is literally in days. I'm on a 4-hour chart here. So this is literally a day and a half that you're seeing here. So I'm macro, but this is something that's come about in just a first leg up move in a very, very short time, and we're going to get many more of these cascading up. So the judicious use of light leverage occasionally can amplify gains in a community where you understand method, you have tight stops, and you already have a very solid, sound investment base already in there. So that's a little bit of amplification that you can add, and that's what we focus on. So that's Ethereum and the crypto markets, and the total market cap. I'll show you that just as a homologation of everything. If we go total 2, for example, that excludes Bitcoin, you see that same pattern structure in here with the movement to 553 billion of a market cap. So that's the summation of all the market caps of everything else outside of Bitcoin. Really, really big. So yeah, we've thrown quite a bit of crypto at you for your part one. And I just highlight here, Bitcoin passed the 50% dominance, which is the beginning of bull markets. That's a shooting star. So I expect the others to start moving disproportionately, which is why we have Ethereum. And we'll then roll into the third and fourth market caps. In fact, my investment pot is already positioned there because those will get higher multiples. So yeah, I'll let you unpack that and see if you want to go gold way.
Absolutely. Let's go there, because Ethereum reminds me of silver, to be honest.
Yeah, the relationship. Yeah.
Same thing, right? The little brother of Bitcoin there. So,
and higher beta as well. When it's good, it's very good, and when it's down, it's hard down.
this wraps up part 1 of our conversation with Francis Hunt of themarketsniper.com. Part 2 will be released on Sunday, so make sure to smash that subscribe button and turn on the alerts to receive a notification directly on your phone or your desktop when we publish it. Further, if you've enjoyed this conversation, we kindly ask you to subscribe, like, and leave a comment below. It helps us tremendously. We're a growing channel, and with your support, we can continue attracting some of the best market commentators. Thank you so much for tuning in, and as always, stay tuned for more.